Every week, the United States government quietly publishes a report that tells you what the biggest traders in the market are actually doing with their money. Not what they say on television, what they are positioned for. Most investors have never read it, the ones who have learned something uncomfortable. The crowd is most confident at exactly the wrong moments. When almost everyone has piled onto the same side of a trade, there is no one left to push it further, and the smallest shock can send it into reverse. This is a guide to reading, positioning the way professionals do, using 3 windows into the market that are hiding in plain sight. The official record of who is long and who is short. The footprint left behind in options open interest, and the price of fear itself, measured in something called Skew. Here is the core idea, stated plainly. Price tells you what the market thinks. Positioning tells you how crowded that opinion has become, and crowded opinions are fragile. You do not need an expensive terminal to see this. 3 of the most useful positioning signals are public and free. The first is the Commitments of Traders report, which breaks the futures market down by who is holding the position. The second is open interest, the number of option and futures contracts still alive and unsettled. The third is Skew, which shows how much more investors are paying to protect against a crash than to bet on a rally. Read together. These 3 tell you where the leverage and the hedging are concentrated. And concentration is where accidents tend to happen. Start with the official record. Since the early 1960s, the Commodity Futures Trading Commission has published the Commitments of Traders report, and since the year 2000, it has come out every week. Most Friday afternoons, it reveals the positions held as of the previous Tuesday in every futures market where enough large traders are active. What makes it powerful is that it does not just count contracts, it sorts them by type of trader. In the simplest version, there are commercials, the hedgers who use these markets to offset fit a real business risk, like a farmer or an oil producer. There are large speculators, the funds and money managers betting on direction. And there are small traders, too tiny to report individually. A more detailed version, published since 2006, splits the financial markets further into dealers, asset managers, leveraged funds, and others. The reason professionals care is a pattern that shows up again and again. The hedgers and the speculators tend to sit on opposite sides. When the speculative crowd reaches an extreme, piling almost entirely onto one side of a market, that has often marked a turning point rather than a beginning. So the question becomes, how do you actually turn this raw data into a read on the market? The trick is to read positioning as a measure of crowding, not as a buy or sell button. Begin with net positioning from the Commitments report. You take the speculators' long contracts and subtract their shorts. A large positive number means the fast money is heavily leaning toward a rise. A large negative number means they are heavily leaning toward a fall. The level itself matters less than the extreme. When net positioning pushes to the top or bottom of its own recent range, it tells you the trade is crowded, and a crowded trade has thin air above it because most of the buyers have already bought. Next, layer in open interest. Open interest is the count of contracts that have been opened and not yet closed. Rising price with rising open interest means new money is funding the move, which tends to confirm a trend. Rising price with falling open interest means the move is being driven by traders closing out, which is weaker fuel. At specific options strikes, heavy open interest marks the levels where the most money and the most hedging is concentrated. Finally, read Skew. Because big institutions constantly buy put options to protect their portfolios, index puts almost always cost more in implied volatility terms than equally distant calls. For the S&P 500, a typical reading has the downside puts trading several volatility points above the matching calls. When that gap widens sharply, the market is paying up for crash insurance. When it collapses, complacency has set in. Three lenses, the same question each time. How crowded and how nervous is the market right now? Skew deserves a closer look because it has its own published gauge. The CBOE Skew Index distills the price of out-of-the-money S&P 500 options into a single number that estimates the market's fear of an outlier, a move of two or more standard deviations, the statistical signature of a crash. It normally travels in a band between about 100 and 150. A reading near 100 says the market sees returns as roughly normal, with little tail risk priced in. Readings up toward 130 and beyond say investors are paying heavily for protection against a sharp drop. In late June of 2026, the index sat around 142 in the upper part of that range. Here is the subtle part, and the reason Skew is not a simple fear meter. A high reading does not predict a crash. It tells you that protection is expensive and that the market is already braced. Sometimes the most violent declines come after periods of low skew, when almost no one was hedged and everyone was caught flat. So skew is best read as a measure of how much fear is already in the price, not as a countdown timer. Combine it with the commitments report and open interest, and you start to see the market in three dimensions. Who is positioned which way, whether fresh money is behind the move, and how much the crowd is paying to sleep at night. This is not an abstraction. Positioning extremes have preceded some of the most painful reversals in modern markets. The classic shape is always the same. A trade works for so long that nearly everyone crowds onto the same side. The commitments report shows speculators at a lopsided extreme, open interest balloons. And often, tellingly, the cost of protection stays low because the crowd cannot imagine being wrong. Then a shock arrives, and because there is no one left to buy, the unwinding feeds on itself. The people hurt are rarely the hedgers who hold offsetting positions in the real economy. They are the latecomers, the ones who joined the consensus just as it was running out of fuel. This is exactly why professional desks treat extreme positioning as a yellow light rather than a green one. Not because the crowd is always wrong, but because crowded trades carry a hidden fragility that the price alone does not show. The same logic runs in reverse at the bottom. When speculators are washed out, positioned heavily short, and the cost of protection has spiked, much of the bad news may already be reflected in how people are positioned. The fuel for a sharp snapback is often highest precisely when sentiment feels worst. So what do you actually take from this? Not a signal and not a trade, a lens. Positioning data does not tell you what will happen next. Plenty of crowded trades stay crowded for months, and an expensive skew can get more expensive. What it gives you is context. It tells you where the fuel is stored and whether the market is leaning hard in one direction with little protection or braced and fearful with almost everyone already hedged. The price tells you the market's opinion. Positioning tells you how many people share it and how nervous they are. Read together, they turn a flat chart into a map of where the pressure is building. The forward question is the one worth sitting with. The next time you hear that everyone is bullish or that a decline is certain, ask the quieter question underneath it. What does the positioning actually say? Because the market rarely turns when the crowd is uncertain. It turns when the crowd is sure. If breakdowns of the market's hidden machinery are useful to you, there are more of them here. This channel explains how markets work. It is educational, and it is not financial advice.